Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Hello and welcome back to Navigating Retirement. I'm your host, Rick Durkee. Hey, make sure you always take advantage of our educational opportunities, and we've got a great one coming up. First of all, let's talk about the Roth strategy. The Roth is a great opportunity. We've been talking about it now for a couple years at the Coastal Financial Planning Group. Many of our clients and newest clients that took advantage of these strategies of contributing to a Roth or converting to a Roth have found that they have now tax-free dollars in the future in a rising tax rate environment. So let's get right into this and see how you can take advantage of current tax laws to avoid some taxation in the future. Now, first of all, there's two ways that you can get money into a Roth account. First way is simple. You make contributions. The second way is you make conversions. Now, there's a big difference between the two. Contributions are putting brand new dollars earmarked for retirement into Roth accounts. Conversions, on the other hand, there's a process here that has to be done, and that's taking dollars that are already in one type of retirement account and then moving them over into a Roth account, or conversion of those IRA dollars, paying taxes now, and then moving them into a Roth account. A lot of people get confused with this information. There's a big difference between the two, as we just learned, and we want to make sure that we're looking at conversion of dollars that have already been contributed in the past when we're making our conversion strategies, and that might give us a little bit more opportunity to get money into those Roth accounts than contributions. So there's different rules associated with both the contribution and the conversion. And when we're making new contributions, we want to make sure that we don't miss the opportunities that we might have with conversion dollars also. And don't get caught up in the minutia of this. Let's just talk about the basics today. First rule of a Roth contribution is you have to have a job. You have to get a check. You have to have earned income, okay? But not too much earned income, or else you won't be able to put money into a Roth. Now, with those higher income earners, there may be some additional limitations on contributions, but certainly you can get some dollars growing tax deferred and also potentially tax-free for your future through some other strategies that we're going to talk about here in a moment for you higher income earners. But let's focus on contribution limits for if you're contributing to a Roth account. First of all, if you're under 50, you can put in up to $6,000 a year. If you're over 50, $7,000 a year. Later videos are going to give you some secrets on how you can do this much, much more. Okay, put much, much more than that into these accounts. Income limitations. If you're a higher income earner, if you are a single earner or single filer, you can only earn $139,000 a year to qualify for being able to put those amounts in that I just mentioned, the $6,000 and the $7,000. If you're married and filing jointly, you can earn up to $206,000 a year. And if you earn over that, then you're not going to be able to contribute to the traditional Roth through contribution methods. But we are going to show you a secret on how this can be done also. Stay tuned here. All right. First of all, remember that contributions are putting brand new dollars into your retirement accounts. Let's talk about some specific strategies for you higher income earners out there who want to take advantage of some large tax deferral balances in retirement accounts that you may have. For contributions, there are many limits and limitations. Conversions are a different story, okay? So there are no limits and no limitation whatsoever on conversions. So you higher income earners out there, should look at converting IRA dollars to Roth. As mentioned earlier, the conversion is a process, and it's a process of taking dollars that are already in one type of retirement account and moving them over into the different type of account called the Roth. This is where the opportunity lives for the higher income earners who are listening today and those exceeding the limits and limitations to make contributions. You've got to consider the pros and cons of any financial move and its tax consequences. That's why we always recommend that after we discover that this strategy may be applicable to you of conversion, that we consult with a competent professional tax advisor, a tax planner, an enrolled agent, a CPA, or perhaps a tax attorney. So let's talk a little bit then about those strategies for the higher income earners or the income eliminated. First of all, there's a backdoor conversion. Now, this is pretty simple. You put money into your IRA and then you move it over to a Roth, but it's complicated in how you do the tax planning on this. Consider that the limit for a contribution is $7,000 and your income eliminated. If we have the same $7,000 available in our hands, then we may want to take that and use that $7,000 to pay taxes on the IRA as we convert it from our IRA into the Roth. So this is what we call a backdoor strategy. Takes a little planning, takes a little tax planning, but you certainly want to take advantage of it if you can't make contributions, but you can still make the conversions, because remember, there's no limits on those. Number two idea, employer plan loophole. Now, this is going to be discussed in our taxes in retirement workshop. Make sure that you register for that today. And also, if you have some specific questions, always remember you can call us 843-735-5065. But the taxes in retirement workshop is going to specifically address some of these opportunities that we have for proactive tax planning. The employer plan loophole, even if we're making significant income and are eliminated from making contributions, if our employer offers a Roth 401k, here's where we can strike a little gold. We can contribute up to $19,500 or $26,000 if we're over 50 into our 401k plans. So here, if we have an opportunity with the Roth IRA in our 401k plans, you just found a way that you can avoid the issue with the $7,000 limit. Now, number three is an often imitated, never duplicated opportunity, as they say, life insurance. Now, people think in retirement, what do I need life insurance for? Well, what if you could pull out cash value and permanent life insurance, income tax free? Would that now be an opportunity where we don't have to look at the Roth rules whatsoever, and we could qualify for a life insurance plan through medical underwriting? If we're in good health, it would be a good move for you to look at. But if you're a higher income earner and you don't want the rules of Roth contributions, you can supercharge your individual retirement income plan, your navigating retirement plan, by looking at how life insurance cash values can be withdrawn income tax free in retirement to create you another source of income tax free retirement. So let's do a quick recap on today's show. Taxes in the future are higher. We all agree on that. It's going to happen. And if we pay taxes now in a lower tax rate environment to save for tax-free distributions in the future, I think we'd all agree that that would be something we'd want to learn more about. We talked about contributions and putting brand new dollars into retirement accounts. We talked about conversions and the no limitation rules of taking current IRA dollars and paying taxes on them now in a low tax rate environment. No matter what your situation is today, if you're working to have retirement accounts, you have at least one option for getting money that will grow income tax free, especially if you're those that are higher income earners. We know what taxes are today. We can buy out the IRS, who's the partner in our IRA today, at lower rates. We can run a report at the Coastal Financial Planning Group showing you how we could structure over time a Roth conversion strategy for you. Look how this will build into your navigating retirement plan with us here at the Coastal Financial Planning Group. Call us today at 843-735-5065. We can show you how you can save money on taxes, maybe a little bit at a time, maybe $1,000 a year for 20 to 30 years of retirement. And hey, I know you, as much as I, would like to have an extra $20,000 to $30,000 in retirement that we saved on income taxes, especially in today's tax environment. So make sure you take advantage of our Taxes in Retirement workshop. Call us today, 735-5065, to set up your navigating retirement plan. And thank you for joining us for this edition of Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.